Welcome to today's Explainer. We are decoding the massive, completely conflicting forces that are literally pulling the stock market in opposite directions right now, on Tuesday, August 11th. We're looking at a market caught in a classic tug of war. And today, we're going to break down exactly who is pulling the rope, how hard they're pulling, and most importantly, what it means for your portfolio. Here is how we're breaking it all down today. We'll start with the market tug of war, then look at geopolitics and oil prices. Move into the big inflation test, do a quick AI temperature check, and finally, wrap up with the 3 things you absolutely need to watch. Let's get right into it. All right, Section 1, the market tug of war. So we have an incredibly tense setup right now. On one side, you've got record high stock valuations in the tech sector, which are really being fueled by this cautious optimism. But pulling hard, and I mean really hard in the exact opposite direction, we have surging global energy risks and massive geopolitical uncertainty. These two forces are absolutely grinding against each other. It's creating this high-tension environment where investors are kind of just sitting on their hands, waiting to see which side gives out first. And you can really see that investor hesitation in the numbers. Look at Monday's close. Things dipped mostly lower on some profit-taking. The S&P 500 slipped just a tiny fraction, 0.06%, to close at 7,753, and the Nasdaq fell about 1/3%, 26,605. But fast forward to this morning, and we've got this stark contrast. Pre-market futures are pointing slightly higher, with the Nasdaq actually leading the advance, up 0.3%. So what's driving this back and forth? Well, it actually isn't earnings yet, and it isn't even economic data. Investors are simply cashing in some profits and moving to the sidelines purely because of global tensions. Which brings us right into Section 2, geopolitics and oil prices. To really understand the anxiety out there right now, you have to understand the Strait of Hormuz. You know the spot, right? It's that narrow waterway between Iran and Oman, and it is the world's absolute most critical energy choke point. We are talking about a full 20% of the global oil and natural gas supply passing right through this one area. For weeks, the market was pricing in hopes that the US and Iran were close to a deal to reopen the strait, which has been effectively closed due to military tensions. But over the weekend, those hopes completely evaporated. Word is the two countries are still miles apart on key conditions, specifically when it comes to compensation for war damages and just the overall scope of what an agreement would even look like. Because that deal fell through, boom, we saw a massive reaction, a 5% jump in crude oil prices in just a single session on Monday. Brent Crude is now trading above $82 a barrel, and WTI is hovering right around 79. And adding fuel to the fire, there was a recent attack on a Saudi Arabian refinery that has tightened the global diesel market, pushing those refined product prices even higher. The takeaway here? A massive risk premium has been injected straight back into oil prices. And for the broader market, that is a huge red flag, right? Higher oil means higher input costs for businesses across the board, and higher gas prices for you and me at the pump. And those higher costs lead us directly into Section 3, the big inflation test. Tomorrow's July CPI report is, without a doubt, the most anticipated economic data point of the month. Everyone is watching this. Headline CPI is expected to cool slightly to 3.4% year over year, down a tick from 3.5% in June. But core CPI, which strips out those really volatile food and energy costs we just talked about, is expected to remain incredibly sticky at 2.5%. Why is everyone obsessing over this? Because the Federal Reserve's next move on interest rates depends entirely on these numbers. If inflation comes in hotter than expected, say headline CPI stubbornly holds above 3.5%, that could totally trigger a Fed rate hike in September. On the flip side, a cool print, that could bring some massive relief and fuel a real market rally. But hold on, because here is the catch. Even if tomorrow's CPI looks great and cools down, the Fed's actual preferred metric, which is core PCE, is projected to re-accelerate to 3.36% in July. So the Federal Reserve is absolutely not out of the woods yet, and by extension, neither are those high-valuation tech stocks that are so hypersensitive to interest rates. Tomorrow is going to be a major catalyst, so you should for sure expect some volatility. All right, let's pivot to Section 4, the AI temperature check. Later this week, we're getting earnings from Cisco Systems, Applied Materials, and CoreWeave. Now, these aren't just your run-of-the-mill routine earnings reports. Think of them as a collective temperature check on AI hardware demand. Cisco's commentary on data centers is going to be a huge proxy for just how aggressively giants like Amazon, Microsoft, and Google are deploying their capital. Applied Materials will give us a window into the picks and shovels of the AI boom by showing us semiconductor equipment demand. And CoreWeave, they're going to tell us whether this absolute frenzy in AI infrastructure is sustainable or if it's finally starting to cool off. And this AI temperature check bleeds directly into the broader tech picture. Just yesterday, Intel dropped 4.1% over dilution concerns after they announced a $15 billion stock sale to fund AI investments. Nvidia dipped 2.9%, and that was even despite the news of a massive $500 billion AI infrastructure funding package with Apollo and Blackstone. But on the flip side, and this is wild, M&A activity is completely alive and well. MarineMax jumped a staggering 46% after agreeing to be acquired by Blackstone, and Varix Imaging leaped 48% following a purchase announcement from Teledyne. So this proves that capital is still moving aggressively out there. But the multi-billion-dollar question remains, can these massive AI valuations hold up under all this macro pressure?
Let's wrap this all up in Section 5, 3 things to watch. If you're mapping out the rest of your week, here are the 3 crucial catalysts you need to keep your eyes on. Number 1, oil prices. This is your geopolitical wildcard. Any headlines from the Middle East signaling a diplomatic breakthrough could send prices tumbling, while any escalation pushes them right back up. Number 2, Wednesday's CPI report. This is your volatility trigger. A hot print triggers a sell-off. A cool print fuels a rally. And number 3, tech earnings. Cisco, Applied Materials, and CoreWeave are the ultimate AI rotation test. If they disappoint, we could see a massive rotation out of tech and into value stocks. So as we conclude this explainer, the market is sitting squarely at a crossroads. We've got record highs testing their absolute limits against rising oil prices and inflation uncertainty. The next 48 hours are likely going to set the tone for the entire rest of August. So I'll leave you with this provocative thought as we head into a highly volatile trading week. In this high-stakes market tug-of-war, will AI optimism outmuscle geopolitical risk, or is the rope about to finally snap? Which side are you betting on? Thanks for joining me today, and stay tuned to see how these numbers drop.